Hello, hello. Welcome, everybody. Thanks so much for joining live. We are very excited to do our annual shareholder event. So, I think this is our 7th year of doing this, maybe. So, this is something we started a while back, and it's just been a great time to kind of take a step back, have a State of the Union, and really just share what's going on in the company with the different investments, and just as a great connect point for our investors. And very excited to have you all there joining live today. We know it's a busy month, and so not everyone can be on live, and so we are recording this, and we'll be able to share this with people after the fact. So if you can't watch the whole thing, or if you want to go back and watch something later on, we're going to share all this later. So with that, we are going to get rolling. First off, a quick schedule of the day. We're going to start off with just some company updates, just share a little bit what's going on over the past year as a company. Then we're going to kind of break down into different verticals that we have our investments in. First being note fund updates. So we're going to run through all of our different mortgage note funds. Then we're going to go into all of our real estate offerings, oil and gas offerings, and then we're also going to share some of the new things we've got coming down the pike this year that we're really excited about. Then Bob's going to share some economic updates. So as you've been following us for a while, been investing with us for a while, you know that we like to have just attention on what's going on in the macroeconomic environment. And Bob's going to share just some things he's been reading and kind of setting the course for 2024. And then we're going to have a little bit of time of Q&A. So at the end, we'll open up to Q&A. Any questions you guys have, we're going to be here for a little bit to do that. We know there are several people watching that are also in Kansas City here. So we have investors across the U.S., even some outside of the U.S. And as you probably know, we're here in Kansas City. So we're going to be doing a little happy hour after this event at 4 p.m. Central. So if you're able to stop by in your local, please stop in. Or if you live close by and can drive, come on down. We'd love to see you in person. Always love that. So with that, we're going to jump right in. I'm going to start off with just a little bit of the intro to the management team. We have a lot of new investors that we brought on last year, and it's always seems repetitive for us to talk about who we are, but we know there's a lot of new faces here that maybe don't know us as well as some of those who've been with us for a long time. So I see on the screen here Bob and Jim, our two co-founders of Aspen, over 11 years ago now, which is kind of amazing, and really started as an opportunistic seeing opportunity in the market to make potential great returns in the distressed debt space. So coming out of the great financial crisis, saw this opportunity into this kind of mortgages, and really from there launched what we now are doing at Aspen Funds at a myriad of verticals, lots of different things that are really excited about. So Bob's background, tech entrepreneur.
Let's let the guys introduce themselves. So, my background is a computer scientist from Berkeley years and years ago. Started at .com. I actually worked as a computer programmer for many years and loved that. I actually loved code. And then started at .com, raised $44 million in venture capital, became the fastest growing business in the Midwest region of the United States in the late 90s, and really got what I call a street MBA at that time. As I say, they're very, very good, but they're way more expensive. And did a few things, CFO work, until I started Aspen. And so at Aspen, Jim and I are the original founders of Aspen. We started in distressed debt, and my main function, I'm CFO today. So I handle a lot of the back office. And really, my strength is in just back office operations and doing a lot of automations and a lot of just financial reporting and those, just to making sure that the back office is solid. So that's my function today, and also chief macro strategist today. So really looking at having gone through 4 cycles, economic cycles. I'm passionate about understanding where the world's headed, and I want to position my capital and my investors' capital ahead of those trends. And so I spend a lot of time thinking about what's coming, a lot of time, reading and those kind of things. So do a fair amount of speaking today around and those kind of things. So that's my role.
Awesome. Jim, you want to give a little bit of your background?
Sure. Yeah. So my name is Jim Mafuccio, and I've been. We have to update the slide here. So it's been since 1986. I've been full time in the real estate development, investment, and mortgage world, and done some syndications on my own way back in the day. Won't bore you with that. But actually, the original idea for Aspen kind of erupted out of my basement in Kansas City. Buying these non-performing second mortgages. So my son was doing the research for me, and I was doing the negotiating. I met Bob in 2012, and over coffee. Very long story, very short. Aspen was born in the end of 2012, and we started in earnest in 2013. So I'll just leave it at that. You can read the rest, but it's been a great first decade of business, and we're looking forward to growing with all of you into the decades ahead. So thanks.
All right, Dan, you want to share a little bit of your background?
Yeah, Dan Schulte. My background is public accounting and securities attorney. I was in private practice for a while, then was general counsel for a New York Stock Exchange traded large mutual fund money manager. From there, I've done a lot of private equity and venture capital. Met the Aspen team as actually an investor and joined up with Aspen in it was pre-COVID, 2018, 2017. And I mainly focus at this point on industrial development and anything else that comes up that needs my attention. So.
Awesome. Yeah. And my background come from commercial banking. So before that, I actually spent a little bit of time in publicly traded boutique asset management for a large private clients, institutional clients, and then went into commercial banking for a good portion of my kind of early career as an underwriter, as a lender, and learned a lot about structuring deals, underwriting deals. And then from there, joined Aspen almost 7 years ago now. And originally kind of focused primarily on capital raising, but have also shifted onto the acquisition side of our real estate and other investment verticals. And so really helping run the acquisitions team, asset management teams, as well as the capital raising teams as well. And so that's what we're doing now, and very excited about kind of where we continue to see opportunity. You want to talk a little bit about just kind of using that macro approach with our investment thesis?
And both Jim and I, having gone through so many cycles and losing everything, maybe someone there, feels the pain of that as well. Getting passionate about really identifying the times we're living in.
Yeah.
And to see things coming. And a lot of trends, you can't really invest in the waves. You can't time the waves, but you certainly can time the tides.
Yeah.
And the really big trends you can see. And so we spend a lot of time researching macroeconomic trends, mega trends, the really big moves. And the idea is that if we can place our capital in those trends, and we pick not only good deals, but good timing for those deals. Where should money go at this time, right? Where is the best investments going to be?
Yep.
Then you find the best deals and the best operators and the best structures. And, and so to me, it just adds a margin, a cushion of safety. If we're doing the right deals, but if you do the right deals at the wrong time, this is what I learned in 2001. It didn't matter how good your .com was. I mean, Amazon was selling for 30 cents a share. And so you want to pick the right timing. And so I want to have everything lined up, all three strategies. So we first look at the macroeconomic trends in place, then we look at the best asset classes and strategies that will capitalize on those trends. Then we form the structures and the teams necessary, bring the teams and the capital together and place it. And we put our own money in every deal, and all the partners do. And we want our investors to know this. And primarily, Aspen is a vehicle for us to invest our own capital. Secondarily, we let our friends come along and play with us. So,
yeah. And to your first point on knowing where the trends are and where the opportunities are, we're seeing this happen in real time in the multifamily space, right? Where the strategies that were working a few years ago, they're not working today.
Right.
And it changed very, very quickly. And the people that built business models, built structures, teams, and, a hammer that's everything is a nail, they're in a very difficult time right now. Right. And so from our standpoint,
but there's always something that is working.
But there's always, and we're actually still playing the multifamily,
but we're playing it different.
We're playing it differently. And we'll talk about that with the new credit fund later on. But it's so important as investors to be, macro aware,
So we want to think like a hedge fund and act like a syndicator,
Yeah.
So, and fund manager.
So a little bit of our track record, you've probably seen this slide before, continue to have a lot of growth, both in our investor capital that we're managing, our assets that we're managing. And now, like we said earlier, hit 11 years on our track record.
Boom.
And just tallied up again recently, investor distributions that we've sent since inception.
That keeps getting bigger.
So that's always a good sign, right? When the money doesn't flow one way, it flows both ways. And that's my favorite number, right? Because it's fun to raise money and do deals, but it's way more fun to perform on the assets and send money back to investors with profit. So another kind of thing, I kind of put a point here that we remain committed to serving accredited investors. This is kind of a natural evolution for a lot of operators that when you kind of get to our size, you start attracting bigger capital and bigger pocketbooks. And we have done that. We have some larger investors that have started investing with us in multiple different of our funds. And a lot of people decide, hey, at this point, let's just move on to the bigger check writers. It's
institutional
capital, family office capital. And we're not going to not do that. But we really are very committed to wanting to provide these opportunities for accredited investors. It's more than just a business model. It's a passion that we all share, and being able to provide these opportunities for investors. And so while we are building out these channels for other bigger kind of check writers and institutional capital sources, we are, as a primary part of our strategy, remaining committed to our investors and want to keep growing. So, we're on our path to $1 billion in assets. And next after that is $1 billion in equity raise. So we have a lot of excitement behind that, and a lot of
and people say, can you grow? And we see no shortage. We could place that amount of money here quickly. We see no shortage of opportunity, no shortage of really, really fantastic opportunities.
Yeah, absolutely. Here's a little bit of the asset classes that we're in right now. I'm not going to go into that because you're going to see every single asset we have here in a few minutes. So hey, if you're not listening to the Investing a Billionaire podcast yet,
what are you doing with your life?
I mean, come on, it's the best podcast out there. We're a little biased, but it's been a really fun way for us to continue, like I said, improving the education and alternative investments and helping people understand, in my mind, is how to level up your investing game, right? So we're trying to bring on different guests. We're trying to produce content that is going to help passive investors learn to be better passive investors, and learn how to implement the strategies, the tactics, the tools that the ultra wealthy, like the billionaires, the institutional investors, are using. And we have a lot of exciting things on the horizon, from the content side of what we're doing, of really wanting to put more out there for people to be really, really helpful content. And one of those things we're doing, which if you haven't participated in the last two, is our Legacy Wealth Summits. So these are usually one-day events. They're virtual, and we are usually centered around one theme, or bringing on a few different speakers on a different topic or a few different topics. And the plan is to do 2 of these a year. So these are, we've been partnering with our good friends, Brian and Kevin over at Sunrise Capital, and they have a very similar passion for accredited investors. And so this is something we're going to keep doing. So I encourage you to keep an eye out for that. We're always trying to bring on some great speakers, great content, and just continue to help advance the alts education. And the next one, very excited about, Bob has been hard at work on. You want to share a little bit about
what?
I know,
just letting the cat out of the bag.
Just a little teaser.
Okay. Yeah, we're working on a book called Invest Like a Billionaire. Surprise, surprise, surprise. And already about 3/4 the way done with it, believe it or not. And it is going to be a really good book. I'm super excited about doing a lot of research. The idea is to make alternatives approachable to people who are more familiar with public markets. And so explain the limitations of the public markets, both mathematically and other ways, and why billionaires are putting 50% of their wealth into alternatives, and how to do it successfully. So even going through kind of making a reference book for each asset class, its pros and cons, when it works, when it doesn't work, these kinds of things, and in really giving investors a leg up to approach alts, understand alts, how to vet operators, how to read PPMs, how to do due diligence, the whole gamut. And so it's going to be pretty comprehensive book, and I'm pretty excited about it.
Yeah, you've been working hard on that. It's been pretty awesome to see the
kind of like a dog with a bone. I kind of get in the zone, and
Yeah, and as you say, we want it to be not just the rah. Hey, you can do this mindset stuff, which it has a place. There's some great books around that, but we really want it to be practical, very comprehensive, like you're saying, a reference guide for how do you actually do these things, right? Because there's everyone gets the idea, hey, billionaires are doing this, but then a lot of people just feel, okay, well, what's the next step? How do I actually feel confident in making these investments, and what should I be investing in? How should I be thinking about my portfolio? So these are the things that we're going to really try to provide a just framework for and a practical guide. So keep your eye out for that. That'll be coming later this year. We're super pumped to get the word out in a bigger way on these kind of things we're doing. So with that, that's all the company updates. Like I said at the beginning, we're going to now shift to the note fund updates. And so this is really where the first offerings and the first opportunities that we started in over 11 years ago. And Jim's going to kind of share some of the things that are happening in this side of our business. So Jim, you want to take it away here?
Absolutely. So I have a book in the works too. No, I'm just kidding. Basically
it's called Happy Hour.
It's called Happy Hour. That's right. That's my specialty. So our place in the residential note industry is, basically it's two sides of the business. We have our income fund, which is performing cash flowing mortgages, and then we have what we call our growth funds, which are the non-performing. We buy broken loans and fix them. So we've been doing this for over 11 years, and Bob and I were in a room actually last week with John Maxwell, probably the leadership guru of the world, and he made a statement that's so simple but so profound, and it really is wrapped up in where we're at here with these note funds, and that is consistency compounds. And we've been consistently working these mortgage models now for, like I said, 11 years, and so we've established through that key relationships, some bank direct relationships, and well-positioned intermediaries, and we're perennial in the space now. We're not when I first started this, before Bob and I joined up, and I think even shortly after, I was thinking this is going to be a maybe 2 or 3 year opportunity, just kind of clean up some of the mess after the mortgage crash, the great crisis of 2008, and here we are in 2024, and we're still active in the business. We have seen inventory in the non-performing second mortgage side that has dried up somewhat, although literally as of even this morning, I had a phone call with our acquisitions director, Tom Moran, and there are a couple pretty substantial opportunities that are on the horizon, and you don't know until you know. So, but stay tuned to that channel, because we'll let everybody know. But you go ahead to the next slide, Ben. So our Aspen Income. So that's the fund that buys. What we do here is we two specific asset types. There's reperforming residential mortgages. These are mostly homeowner loans and people that have had a modification done on their mortgage. They've come out of the crisis, solved their problems, and so we've been consistently buying those loans. And then the others, and that's probably about 55% of the portfolio, which is now, by the way, at about $85 million, and that's acquisition basis, that assets under management. That's not payoff balance. And about 45% of the portfolio is now what we call hard money loans or asset-based loans, and these are bridge loans. Somebody who wants to do a fix and flip, or just has to jump on an opportunity and needs fast money, and it's high interest rate money, and we love it. So it's really balanced our portfolio because we have a lot of liquidity, money coming in and going out in the fund, but we've had a consistent unbroken stream of payments to our investors since inception in 2014. Have not missed making our preferred returns to our investors. Haven't really even come close to missing it. We have seen yields compressing a little bit, which basically means we're having to pay a little bit more for some of the reperforming mortgages. It's gotten a little bit more competitive in the space, but we're still doing really well. And then we probably are wondering what effect has interest rates had on this particular asset class. And it's people have not been paying us off as regularly. You can see there in the slide says we had 202 payoffs in 2023 versus 342 in 2022. It's just a little harder for people to refi. There's not as much of an interest rate incentive, which we're fine with because we're sitting and collecting a really nice, typically low teen yield on the capital. So we're making great money until they pay us off, and then we make great money. So we've seen a little change there. The value of these notes really haven't been impacted much by the higher rates. This is this asset class it's pretty insulated. There's not that many players in the space. It's not out there in the public markets. We have seen some bigger players come into the space bidding ridiculously high prices for some of these, but we're thinking that's not going to be the norm. We have a bank line of credit that is very conservative. We're typically less than 10% of the asset value is do we have leverage at any time. We really use that to run up our acquisitions and then backfill that by raising more capital from our investors. We are in the middle of we're just wrapping up our fifth proctology exam. Financial audit. So this will be our fifth year straight of being GAAP compliant, and that's a pretty intense bit of due diligence on our fund. So that ought to make everybody feel more secure. So go ahead to the next slide. Oh, there we go. So the Aspen growth funds, these are where we buy the non-performing loans. And in general overview, as those of you that have already invested with us in these funds, the courts have been backed up post-COVID, especially in some of the East Coast states. So a lot of things just weren't coming through the pipe. And unfortunately, a lot of times we don't get loan modifications done until people are under the threat of losing their home. And then they come to the table if they're going to come to the table. So that has slowed down our exits in the past few quarters, but we have seen that pick up most recently. The courts are getting unlocked a little bit, and so we're seeing some exits increase. A large percentage of our notes are in the final stages of the foreclosure process, and so we anticipate we see some pretty large exits coming down the pike. We do, however, our workout team is still very active, and we're still achieving a lot of what I call 11th hour modifications and settlements. And again, this is when they've kind of played a lot of our borrowers. They're not dumb, and they're taking advantage of the long extended clock with some of the foreclosure process. And so they'll wait to the very, very end, and then all of a sudden, hey, I want to do a modification. And so we are getting some of those done. But increasingly, we're seeing our payoffs and our exits come from either they decided to sell the property and we get fully paid off at the sale, or we approve a short sale where we take a little bit of a discount. It's still a great profit for us. And then foreclosures actually, which isn't our preferred exit, but we do everything we can to reach out to folks. The massive increase in home values since 2020 has really dramatically increased our equity position and therefore our achievable margins. We don't have to give up as much, but we're still fair to the homeowners, but it puts us in a really nice position with these assets. There has been somewhat of a recent decline in some markets, although a lot of markets now appear to be turning back up. So hard to say, but since 2020 overall, there's a ton of equity sitting above our positions in these assets. So our leadership position in this industry has created new sources with large institutional players. Again, we're not actively raising right now for these funds, but that could change literally. I mean, we could get the right phone call in the next day or two, and that would change the story, because we do have a couple large institutions that are we're in talks with about releasing some of their product to us. So go ahead to the next. So just really quickly, here are the 3 funds that are still active. I'll start at the bottom one, actually, Aspen G. This fund has operated for over 10 years, and it's now winding down. About a year ago or so, we stopped raising more money, and we stopped acquiring notes in this fund because we did start to see the supply tapering off. So basically, everything that comes in, we distribute out to pro rata to our investors on a quarterly basis, except what we need for operating reserves, which isn't that much because there is good liquidity here. We have about 120 assets remaining. The book value of those is about $5 million, and the total payoff balance on these assets is 11.7. So 11.7 million. We expect that we'll end up collecting somewhere in the 60% plus or minus range of that. So for you investors that are in Aspen G, there is still a pretty good bit of meat on the bone. It just takes the time to get to reach the exits. But as soon as those loans exit, we distribute everything to our investors. So I think at the end of the day, that will have been a long-term, pretty solid internal rate of return over the life of the fund. So up to the top now, Aspen Growth 4. That was a closed-end fund where we raised all the capital, then deployed it, and then started exiting the notes. So we've been, let's see, there's 123 loans left in this portfolio, and the total payoff balance is about 14.4 million. The really good news on this fund is we've already distributed back to the investors over 143% of the original capital. So basically everything from here forward is house money. And I don't mean our house, I mean your house. So we share it with you. So for the 14.4 million payoff balance, again, probably for this portfolio, somewhere in the 50 to 70% of that figure is what we'll still collect and bring in. So that will be going out the door to you investors in that fund every quarter. The fund that is still open, Aspen High Yield, and it's kind of an evergreen fund. We're actively working through a portfolio there. We're not currently raising money, but again, once an opportunity hits our doorstep, we're going to be putting out the call because it's typically a pretty big takedown that we have acquisition opportunities. So, but we do have a pretty large portfolio still that we're working through, 218 loans with a payoff balance of $30 million and the book value of about 9.5. So there's still some pretty good headroom there. And for our investors, we've maintained an unbroken monthly payments since the inception of this fund, which has been a few years now. And so all is well. The thing I wish we had was, an unlimited supply of these assets because we continue to generate, 3x plus or minus return on acquisition price. And it's been a really sweet business model for us, and we appreciate all of you that have participated in it with us, and we look forward to doing more.
Awesome, thanks, Jim. That was great. Real quick, so I'm seeing some of the comments come in. That's awesome, Francois. Good to see you, David. Good to hear from you, Andy. Hey, so
by the way, I got us back on the schedule. I just wanted to say I talked fast. I got us back on the schedule.
Yeah, that was perfect. So comments. So please put any questions, comments you have, put those in the chat. We're going to wait till the end to address those. We have a lot to cover. And so we will do the Q&A at the end. And so anything's on the board there. We're going to also hit the economic stuff at the end. So if you have economic questions, hit that. Fund specific, hit that. Broad questions, put those in. If you can't stay for the whole time, obviously we're recording this. So we'll just send this out once the recording is available. And then you can go back and watch if you want. Obviously follow up with us if you have any additional questions. But definitely start putting comments as they come up or you have thoughts along the way, and then we'll address them at the very end. So I'm going to go run through now all of the real estate that we have. So this is from a volume standpoint, a number of assets. We're doing every single asset, both syndications and funds that we have. So I'm going to kind of fly through it because there's a lot to cover and really trying to just distill it down to a few kind of key points for every asset. So if you do have follow-up questions, obviously feel free to reach out to us. But with that, I'm going to kind of dive right in and keep this party going. So big picture, right? Jim kind of talked a little bit about this, but if you haven't been paying attention to the news or anything going on, interest rates have risen. So it's actually been the fastest rate increase in history. That last really 2022, 2023. And this has been kind of a pretty big shock to the whole financial system in a lot of ways. A lot of people were anticipating a recession, which we still haven't seen yet. But it has the interest rate pressure has significantly slowed down transaction volume in the commercial real estate space, and really across any investment category in the kind of real estate sector. Interest rates generally have a inverse relationship to valuations, though it's not one-to-one. It's not a perfect correlation. We have seen valuations come down, right? As cost of debt rises, the price that buyers can pay goes down. So what's really happened is it's not a great time to sell, right? And this is kind of across the board. And that's not to say we won't sell assets opportunistically here or there in the near term. But it's really shifted our perspective and a lot of the plans that we maybe initially set out with to kind of go to a plan B or to pivot, which I'll talk about on each individual asset here in a minute. But the good thing is on a lot of these asset classes, and because we're, again, paying attention to those macroeconomic fundamentals remain strong in all these asset classes. And there's a lot of capital on the sidelines. And we really believe that over the next few years, as that capital begins to get comfortable with what's going to happen in the market, right? The big challenge right now is not only that interest rates have risen, but there's uncertainty as to where do they go next and how do we know what to expect, right? And when there's confusion or, low confidence in what's going to happen, capital slows down. But there's a lot on the sidelines, a lot of capital looking for assets. So we think there's going to be a lot of demand that will, kind of come back to the market over the next couple of years. So like I said, we've pivoted strategies on a few assets. And, as you know, and you invest in these assets, we always have plan A, a plan B, a plan C, on and on and on, because we want to have multiple ways to protect capital, protect investment, and also maximize investor potential return. And we feel that right now would not be doing that for our investors in a lot of these assets. So our strategy right now, we're effectively managing all these assets, and we will opportunistically sell if the market is saying, hey, now's the time. The great thing, though, and we say this all the time, and part of the reason why we're really excited about these assets long term is inflation is a great friend to real estate. So you want to share a little bit? I know you're probably talking about that a little bit later, but why is inflation such a great beneficiary to?
Yeah, and so this is it alludes to this, but at Aspen we want to be a little bit smarter than the average bear, and we try to do that. And he mentioned plan A, plan B. Really, we always have we pretty much put out there our plan A. We don't always put out there our plan B when we're raising capital. So plan A is, hey, let's go flip this asset in 3 years. But right now it's not a good time to sell, and so in our industrial portfolio, we may not sell right now, right? But that's okay. Maybe we'll take a cash out refinance, return capital to investors, and hold that puppy for a little while.
Yep.
And so what happens, interest rates hurt valuations in the short term, but interest rates and inflation are tied at the hip. And so what happens if you have high interest rates, you almost always have high inflation as well. So while high interest rates make it hard to hold and hurts your cash flow or make it difficult to hold reduce valuations over the long haul, inflation is going to massively increase the value. So,
Yep.
So at 8% inflation, in 10 years, your asset doubles in price. So it heals all problems. So plan B, a lot of times, is just a long-term hold. Let's flip our strategy to a long-term hold strategy. We're going to make money. We're going to protect our capital no matter what. And so we want to position our assets so we can play either game. And that's what we've tried to do. And we've tried to be conservative in most of our debt and most of our debt assumptions. We're well capitalized. We have deep pockets as a team. And so we're going to, when you get in trouble, you can't ride the inflation if you can't service the debt. So you always have to make sure you can service the debt and then ride out the inflation wave. And surf that puppy, because it's
Yeah.
it's going to make a lot of people wealthy. So yeah,
Yeah.
that's our strategy. We don't talk about it a lot, but that's that's the way we're playing the game.
Yeah, absolutely. And the funny thing about a pro forma and when we're doing these deals is, the chances of you hitting it perfectly are almost nil, but you want to have a plan and a path where you want to go, but then have options and have, think through all the risks of how you can pivot as needed. And, we
look at pivots. We actually plan all the
we
pivots.
plan
We look
plan
at all
the
of them and say,
pivots.
wait a minute.
Yep.
Is there a plan B? What's our plan B in this asset? And hey, what's a plan C in this asset?
Yeah.
And we make sure we always have multiple exits, right? For every deal.
Yeah. And, we're going to go through all the asset specifics here, but we've heard a lot of other sponsors have been struggling, been making capital calls, been
capital calls for Aspen.
having challenges with investors, but we've not made any capital calls. We don't anticipate any at this point right now. We have great lender relationships. We put in some great debt in place in a lot of our assets, and we're doing pretty well. So I'm feeling really good about where most of these assets are at, and feeling excited to share some of the news here, including a lot of our assets are ahead of pro forma, even despite some of the challenges. So first one, so Aspen Storage Fund 1. So this was a portfolio that we invested in of 9 self-storage assets, mostly in the kind of Georgia submarkets, very, very strong markets for storage and real estate in general. The idea here was to improve economic vacancy because the street rates were much, much lower than the market, even though the physical occupancy was high. And so we invested alongside a top 50 operator, and self-storage is actually one of the best ways to inflation protect because of the nature of the leases are very short term, usually month to month. Because of the higher interest rates, this particular portfolio was impacted on a cash flow standpoint because the refinancing acquisition, or sorry, not refinancing, but financing at acquisition really impacted the free cash flows available. And so as we have from really the beginning, we have not taken any of our fees until distributions continue, so that the distributions of this portfolio have been paused for the time being. But positive thing is got a recent valuation from several brokers, and valuation came in at over $54 million, which is $6 million higher than the last valuation, which was done shortly after purchase. So even despite the higher rates, right, which generally have a negative impact on value, we've actually seen values rise. And the real reason is because of the business plan here, which is improving economic occupancy. So that's a combination of increasing physical occupancy and increasing the market rates. And so there's been significant progress towards increasing the market rates. And now the next stage is pushing physical occupancy. So the portfolio right now just surpassed 80%. So as that continues to climb, we expect that free cash flow number to rise, and we'll hopefully be able to make distributions here probably later this year. But it's, again, focused on long-term value, which is creating one, more square footage, two, increasing street rates, and ultimately having a great exit for investors at the end of the day. These are the storage portfolio we have. This was a redevelopment of a vacant office and retail space. We converted it into 120,000 square feet of both climate controlled and non-climate controlled storage. This is in our backyard here in Independence, Missouri. It's a submarket of Kansas City. Great location, right off two highways. Very limited competition. And it was a great arbitrage from our standpoint, from a development standpoint, because it was cheaper to basically convert this project into self-storage than to build ground up from a development cost standpoint. And again, we like this asset class from an inflation perspective. So the updates at this point are all construction has been done. All the climate controlled and the units outside, the exterior units, have all been completed. And so since really the beginning of this year, we've been focused 100% on leasing. And so that's been the main focus. At the end of last year, we did explore a potential sale, a kind of a C of O sale, so certificate of occupancy, and that was one of the potential options that we had at the outset of, hey, we're going to go and see what the values are once we get this ready to lease up, right? But what we found when we took it to market was obviously, everyone's kind of pulled back. There's not a lot of people, paying great prices right now. But the bigger thing that we saw, which is really encouraging actually, is the discount from a kind of C of O to a stabilized property was very, very large, meaning the premium.
If we took the effort to
achieve,
lease it up, we would get paid in spades, basically.
Yeah. So we looked at the stabilized value of what this property is going to be worth at stabilization. And it was pretty much a no-brainer to, we have the ability
hold
to
it
go
and do the lease up.
Yeah.
And
we already started seeing when we were, doing that marketing process, the demand that we were having from tenants. And so since, fast forward to today, is through some little snapshots in there, you can see this is a pull from Google, but we have 76 reviews, 4.9 stars, incredible market reception. And we're working with Extra Space, formerly Life Storage. They are, a top operator and really know how to lease these properties up fast. So we recently just crossed 33% occupancy, which in a self-storage investment, excuse me, the lease up is usually much longer than an apartment building, right? Because we have about 900 units or 850 units in this property. So there's a lot of units to lease. So it's a little bit slower, but it's much stickier, right? Once people put their stuff in these units, they tend to not come and get it or get it very often. So we're already at 33%, which is awesome. In fact, this is the fastest leasing property in the Extra Space system in the whole of Kansas City Metro. So super
so
encouraging.
They're super happy about it. And,
yep. So from a performance standpoint, we feel really good. The ultimate valuation of a stabilized project at pretty conservative cap rates is in line with our original pro formas. And so we anticipate this is going to do really well for investors. Shifting to our multifamily projects. This is a 48 unit property we have here in Kansas City. This is a value add project. There's a lot of opportunity to capture upside in the leases. And again, inflation protected. We like that. And, we purchased this in April of 2022. We decided to get fixed rate debt. And at that point, rates were still pretty low. I wish we'd go back to that time, but maybe at some point. And we also did local bank debt, right? And so most of these assets have local bank or regional bank debt that are actually recourse to the partners here. But we decided that was the best option for these assets and to get a fixed rate. So we have a fixed rate of 4.25%. We still have obviously about 3 years left on that debt. And we are hitting some pretty awesome milestones. We're actually well ahead of our pro forma EGI, our revenue. And right now we're at 98% pre-leased occupancy. So very strong in demand, even with pushing the rents.
Is that Class C? Is that Kansas City? What's driving the value here?
Yeah, it's affordable housing, right? So this is Class C, and it's in a great area. It's actually pretty close to downtown. Not a lot of other options, and our finish level at the price point that we offer is a lot nicer than what's in the market. Mm-hmm. So it's causing a lot of demand for that. And we're actually not talking about pausing distributions like probably a lot of operators you may be talking to are. We're actually going to be starting distributions because we have the great debt in place where we've achieved our stabilization. And so we're actually looking at sending our first distribution here soon.
These two deals, what is our forward-looking exit plans? Just talk about what do you think exit, speculate on what exits might be.
Yeah. So again, we're testing the market. A lot of these things, we're talking with brokers, we're getting broker opinion of values, and some we actually have made engagements to go take it to market to see what's out there. What's kind of interesting right now is everyone in the space is kind of trying to see what the bid ask spread is, right? So all these brokers like, I can go get you this price. And you're like, well, if you can get that, I'll take it, because that's like kind of my target exit price. And they go take it to market, and they really have no idea what they're going to get. And so they kind of throw spaghetti on a wall is kind of what it feels like to me. So there's just this pretty big divergence of the bid-ask spread. I do think it's narrowing, meaning the price that sellers want to sell and the price that buyers want to buy at is narrowing. So I think it's coming closer, but there's still a pretty big disconnect, right? And so this is a great example of, hey, we have the potential to maybe sell early, but we don't need to. And in fact, we're just going to continue to make distributions because of the price point of these units. We have a lot of room to keep going up, and there's just not a lot of options or supply. And
so no reason to sell at this point. We think the value is going to continue to increase, and we're just riding that wave. And what about independents? I mean, we're seeing it going to be pretty much leased, we think, close to the end of this year, right?
Yep.
At that point, we stabilize. At that point, we can start raising rents and potential exits this year, next year, or really is it more of a long-term hold? What do you anticipate?
Yeah,
or is it a cash out refi and hold for a longer period?
Yeah, so great point on the cash out refi, because we actually did do the analysis on this property as well as several other properties on. Well, let's do a cash out refi, right? We had debt at one level of value at purchase. We've now increased the value because our NOI is substantially higher.
So pull out cash.
So hey, let's go do a cash out refi and pull out cash. Well, the problem is because of the higher interest rates. It doesn't pencil as well. We can pull a little bit of cash out, but because those higher interest rates, the leverage points are much lower than they were a couple of years ago. I think those will come back up over the next couple of years. And then the really crazy thing is the interest only payments on some of that agency debt that you can go get for permanent financing is actually about the same as our amortizing debt right now. So we're actually amortizing on this property. We're still going to be paying out distributions with amortizing debt, meaning we're paying principal every month. And so we're actually expanding our equity while making distributions and just holding on until a better time. And so that's the great thing about it.
So we don't really anticipate exits in either of these in the next couple of years as it stands.
I would say no. I think in my mind, a lot of these we have to pivot to a multi-year kind of time frame
because of
really
interest rates.
Because of interest rates, and really to see when the capital comes back. Right, when the capital is ready to go shopping again, that's when it's time to sell.
So bide our time, but meanwhile, it's just getting more valuable. Right?
Yeah, and the great thing with independence, I mean, we've done some pro forma analysis on the cash flow on this because we have also great debt on this property too, with another 3 years. And if we stabilize by the end of this year, this thing's going to cash flow like crazy, even without a refi. So
and could start distributions.
Yep.
Good.
So similar here. This one's just a little bit behind. We purchased it a few months after the former one, the North Park. This is the Parks, another 95-unit property in Kansas City. And again, we're a little bit further behind the North Park. We're still finishing out the renovation program, but we're very, very close to finish. I think we have about 4 units left to finish. And in the spring leasing season, we've had a huge surge in occupancy. We're already pre-leased at 92%. Excuse me. We have great debt, 4.24%, and expect to stabilize this.
Do you have all those rates memorized for every one of these deals?
Well, I wrote it on there, so I had to write it right.
I didn't see it,
but yeah.
Okay. Like
when they're in the 4s and 3s, I like to remember those numbers a lot. So, so we're expecting to stabilize over the next few quarters and start distributions shortly thereafter. So this one's kind of in line with the other one as well.
It's interesting in the multifamily space. We've got some of the deals that are kicking tail.
Yeah, you look at. I mean, what's really causing the challenges? One, I think it's the big hot Sunbelt markets that you're buying at 3 caps, right, or 4 caps.
Mistake.
It's the debt that's over leveraged and now floating interest rate, and we're not in Kansas City. What's crazy is we're not having the same supply demand issues that a lot of these heavy supply markets are seeing. The projections for this year are actually a 6% rent growth.
This year
growth in Kansas City in 2024.
Which you're not seeing that in the Sun Belt.
We're not. We're actually seeing rent declines, right, to lease up things. So I think it's really market specific, and that's why again we're paying attention at the big picture first. The markets and then assets. So watercolors. It's a property we're actually
just there yesterday.
Yesterday we did a little site visit.
Beautiful property.
I love this property. We got great assumable debt at 3.49%, with about 9 years remaining. I think that was from last year, so probably 8 years remaining. And purchased one directly from the developer. the first 2 phases, and we've been basically renewing all those lease trade outs. I mean, pretty substantial trade outs. And so this market's a very hot market, Northwest Arkansas.
2 miles
Bentonville.
from Walmart headquarters.
Yep. Yep. It's a great location. So we've had the first 2 phases, and then we bought the 3rd phase last June
At C of O, empty.
At C of O, empty. It's 144 units. And so this market is a little bit different than Kansas City because this is a growth market, very much a growth market. There was a lot of supply that hit the market. And so we are seeing a little bit of a slowdown in the lease up. But the positive thing is the first 2 phases, phase 1 and phase 2, we're actually surging back up to 95% pre-leased occupancy. And we're trading out a lot of these leases at our new rates that were in some cases, I mean, it's kind of crazy, like $500 to $600 a month higher than what the developer had. Right, the developers want to get warm bodies in the building, and so we're able to achieve these rates. But it's been that process of turning that rent roll and increasing those prices has been taking some time. And then because of that, we're kind of also having to focus on phase 3, right? So we kind of have these 2 different parts that we're trying to do: retain tenants in phase 1 and 2, and then also lease up phase 3. Because of that extra supply, the market's been a little bit slower to absorb than we initially expected. But thankfully, we are seeing a real quick surge here with this.
I love our team there. We met a bunch of the leasing girls, and man, they're awesome. They're on it.
Yeah.
They're
so
on it.
The other kind of part of the story is we had a property manager in the last fall that we thought was great. They were a big, well-known name, had assets all over the place, but started noticing things that just weren't making sense, and just started to realize they were not performing. And so we had to get them out. But that whole transition just took some time. But now getting the new folks in place, we also just won. I forgot to put it in here, which I would have. We just won an award for one of the best apartments in Northwest Arkansas.
Best place to live in Northwest Arkansas, something like that. And it was amazing. Yeah.
Yeah. So now we're using that to kind of promote and help get people leases signed. And so we're currently at 60% occupancy for phase 3. We're expecting to have that.
And 95 for phase 1 and 2.
95 for phase 1 and 2. We expect that phase 3 occupancy to be in the 90s probably over the next few months. I mean, it just increased by 5% last week, so it's moving up quick. So because of that, we did temporarily pause distributions for investors because we needed to make sure we could get that stabilization of phase 3 in place. Again, we're expecting that to happen over the next quarter or so, and then we'll likely resume distributions once we're cash flowing again. Because we got that great debt in place, we expect that to happen.
With that great debt in place, why should we sell this puppy?
I want to ride this market. This is So we actually put a 5 to 7 year hold period as the primary business plan on this asset, and I think that's going to be the angle. Is there's so much appreciation in this market. I think it's going to be
we're going to make a lot of money in this deal.
Yeah. So as a point, and I'm making this point on any asset that's maybe kind of sub-performing of what we initially wanted, or it has kind of a temporary thing we're working through, we have paused taking any fees as GPs until distributions continue. So we want to put ourselves in alignment with our investors, and so if our investors aren't getting distributions, we're not going to take our fees on this asset, and working very hard to get this thing up to stabilized numbers, and feeling really good about where it's at. The Louis. So this is another beautiful apartment building that we just purchased actually a few months ago in December.
Great asset.
Yeah, this one kind of just dropped in our laps, and it was hard to say no. It was literally just in our backyard, and in the best submarket in Kansas City, Overland Park.
And there's no availability in this.
No availability, no new supply coming in. This location is right in the heart of a lot of shopping, a lot of kind of main thoroughfares,
and it's townhomes,
huge units,
super desirable.
And it's the best school district in the state is in Overland Park,
and some of the best in the nation. So huge draw.
Yeah, huge draw. So it really draws the families. The townhome style units are very, very large. They're actually 3 stories if you include the basement, and so they're awesome. So the cool thing is we just purchased this one, so it's a little bit early to give big meaningful updates. But the cool thing is we're seeing some kind of corroboration of our business plan with some of our recent unit renovations. You can see some pictures there. This is some of our pictures from the website. So just really beautiful finishes, and it's very attractive for this kind of market. We actually signed one of our first leases on one of the renovated units at $25.45 a month, and it's actually $245 higher a month than
our
pro forma.
projections. Yeah.
And we knew we were conservative, but you don't know in a market that's not putting out a new renovated use like this. So we feel really good about that. And
they're busy painting and fixing it up all over there now.
Busy painting, yeah. The exterior paint's almost done. We're going to renovate all the poolside area, the kind of hangout area right around it. And so right now we're maintaining about 90% occupancy. We're actually pre-leased to 97%. I just looked at yesterday. So we're going to just do this as a slower renovation and maintain high occupancy to keep cash flow going. The great thing is we only need to renovate 44 units of this 200 unit property. And so we kind of do that over the next 12 to 18 months and bring all the
and you
rents up
missed
to market.
3.9% interest rate.
Oh, minor detail, but I'm glad you brought that up. Yeah. So we got a great assumable loan from Fannie Mae again. Okay, now we're shifting to some more retail assets. So, shifting from storage to multifamily now to retail. And, if you've invested in these assets, you know why we love them. I mean,
I'd sure love to do more of these.
Yes, they're harder to find, but when you get some of these, it's just awesome, right? So it's neighborhood strip centers. These are kind of in the heart of suburban areas, usually right by neighborhoods and kind of right on your way home. Gotta go to liquor store, gotta go to the mobile phone shop, gotta go get my hair cut, get my dog groomed, all these things that are not going to be replaceable by Amazon, by the internet. And there's just no supply. I mean, hitting the market. They haven't built any of these in forever.
Huge shortage available.
Yeah. And so we're buying these at pretty amazing cap rates. In fact, you're generally in positive leverage territory, even with high rates right now, which is pretty hard to say for most other asset classes. And, it's kind of mom and pop owners. And so we're able to really kind of bring a more institutional level approach to negotiating leases. Most of these leases at this property, QSGG's, is a combination of two properties. They're all gross leases and they're under market rents. So gross leases means that the landlord pays for, property taxes, maintenance, and insurance. And now we're going through and converting those
everything to triple
net, and we're pushing a lot of those costs back to the tenant. Not only pushing those costs, but also increasing their stated lease rates, and so that has a double effect of increasing our income coming in. And so we're already seeing this. It's a slow process, right? Because these leases generally are longer than multifamily lease, usually several years. So we look at what's called the weighted average lease term. So we like that to be short, right? Because if that's short, that means we're going to have more turnover than
which we like
in a shorter period of time. Which some people think, why do you want more turnover? But because these are under market rents and there's
opportunity to raise rent and convert to triple net.
So we're converting. And so this is kind of a dual impact of restructuring leases plus doing capital improvements, improving the aesthetics, making these look a lot nicer. And even while we're doing that, we're actually paying out distributions. So we're right in our line with our pro forma, right? In this property, we've been distributing between 5 and 7% cash on cash every quarter to our investors.
These, is there a potential exit sooner for these because we bought at such a high cap rate? Is there a potential cash out refi potential and potential exit sooner than is it, in the next few years?
Yeah, there's definitely a potential for any of those scenarios. I think, again, capital markets in general need to kind of come back with a little more heat, I think, to bring cash to the market. I do think
want to see buyers entering the market.
Yeah, we now have 5 of these assets in the Kansas City market, and 3 of them are like right by each other, or 2 of them right by each other, and one's it's like just blocks away.
Might be appealing to a larger buyer.
So if we can pool some of these assets together, increase the overall strike price, then I think that can also be attractive. But the great thing too is, we have great, local bank debt on these, but they're usually pretty conservative because they actually don't like the short lease terms, right? From their standpoint, that's a risk.
Bankers.
But what we know is there's a lot of demand for these types of properties from a tenant standpoint, and there's a way below market. So let's go and increase the NOI, and we get this more stabilized, better rent roll with triple net leases. We can go and get much better debt, stabilized debt, and so it's a very high likelihood that we'll probably do a cash out refi at some point in the next couple of years if we don't sell.
What's our vacancy rates average?
All the 5. Well, it's different because some properties are much heavier value add. So I say the ones that are just turn and burn, just restructuring leases. It's in the 90s for Quivira, which is our kind of bigger heavy construction one. It's still pretty high. I think it's in the 80s. So it's overall very, very high. And this is one that Mission Hawk. This is when we purchased about a year ago. Very similar thing. Great basis. 8.64% purchase cap. And one of the crazy things we're seeing on one of the properties in Mission, which is a great area in Kansas City, is we've had an extremely high renewal rate. So again, because there's not a lot of supply, not a lot of options, these tenants don't have a lot of options, right? And if it's a good location, they're going to want to stay there, and they're willing to accept the higher rates, and they kind of get it because inflation's been going up and blah 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 blah. So they understand it.
You've seen retail sales, it's been on a rip, in the last 5 years, but they've not built any new strip centers in 15 years. So it's a huge shortage. As a retailer, you need a place to retail. Yeah. And there's just nothing available.
Yeah. And these suburban centers, are high in demand from a tenant standpoint. They want to be where the people are that are working from home now and making these kind of short trips, close to where they live. Again, this one we purchased a little bit after the last one, but we are currently making distributions right around 5% cash on cash. This is the most recent one we purchased. Actually need to update the date. It's supposed to be 2024. So we purchased this one, not 2024, sorry. We purchased that one in December of 2023. And so we purchased this a few months ago. This is actually adjacent to Quivira Square, one of the other ones we own. The first one I showed you, literally across the street. So we can kind of control this little part of the corner of the streets here. Again, another great basis, 8.12% cap rate, but that's on existing cash, right? And there's a lot of upside. So these can usually stabilize in the low teens from a yield on cost standpoint of what we can earn on the improvements and restructuring the leases. Bought this from a mom and pop owner. Already starting to implement the business plan. We've already talked with all the tenants working on restructuring those leases. There's a very short weighted average lease term on this property. So there's a lot of tenants coming due with their leases. And we're going to make some improvements. We're going to get them what they want, which is drive more traffic to the shopping center. And so we're already making those kind of aesthetic improvements to really brighten it up, and expect to start distributions here probably next quarter. We usually wait 2 quarters post acquisition to begin distributions on the property. So looking forward to that. Okay, industrial. So this has been great. Iron Horse. Dan, do you want to share a little bit of what you're seeing on the Iron Horse here?
Yeah, just a summary. We closed on this land, I guess, a year and a half ago. So construction's gone well. We finished building 1 in October. That was a 200,000 square foot building. Building 2, we should get C of O on Monday. Good news on the leasing side.
Well, and we did this on time, right? And under budget.
Right. On time and under budget. And this was the conclusion kind of a project I started in a previous life. So this is on the south side of Wichita, equidistance between the aircraft plants on the east and the west side of town. We're close enough we can announce that we should have a signed lease on building 1 for the entire building at above market rate on Monday with the first lease payment. That's a multinational, publicly traded, obviously very high credit tenants. So we're very happy about that to get them in there. That lease would start immediately, and they take possession immediately as well. And then on building 2, we have a number of LOIs out there. We think we'll probably have that leased up Again, that's 134,000 square feet. Have that leased up probably by this summer with possession either this summer or in the fall. The plan here was to fill, and then Ben, you can probably talk about this, your thoughts. The plan here originally was to fill these up and then look to market them and sell them for a return based on the conversations we've had over the last hour or so with interest rates. This is probably going to be a refi and a cash out at the appropriate time to our investors with a longer term hold. I didn't know if you wanted to add anything on that, Ben.
Yeah, we're still in discussion. So, we have some brokers that are kind of looking at values and evaluating the market for a potential sale. But as we've seen, is when we've done that for the last few assets, it's just, again, not a great time to sell. And when you have good debt in place, when you have a great asset with good cash flow, there's a lot of other strategies that I think are going to be in the best interest of investors. And this scenario will likely be a cash out refi. And we've started modeling some of that and expect to be able to return some capital
looks good.
back to.
Looks like it might pencil.
Yeah, could pencil pretty nicely. So, so this has been going great. And I don't know if it's kind of too early to talk about the potential little flex buildings there, Dan, that we can potentially have the option to do on this project, or we want to wait for that. But I think
we'll just talk about it, Dan. Just what you're thinking.
Yeah, we wish we had more room here for another big building because basically, as we've talked about in the past, in the last 18 months, everyone's gone pencils down on construction, and so there's going to be a lag in the market, we believe, in the next 2 years in terms of no availability for these large buildings. But here on the Iron Horse, you can see in that top picture, there's a little 3-acre spot that's still, with the lawn there. We're talking to the owners of that land to do a JV. The owners have the other 2 buildings on site. Put some flex building in there, and as people know, flex is in huge demand. Smaller buildings, 25,000 feet. Put a couple of those buildings in there, and then probably in 3 years when we go to resell, that'd be a really nice package to have both big buildings and both flex buildings for an exit. So that's kind of our thought. Still going through that budget, seeing if it pencils, but that's really what we'd like to do on that site.
Yeah, perfect. I'll come back to you here in a few minutes, Dan, to talk about some of the things we got going on.
Very exciting stuff. We got
up,
just a huge potential for more of that.
Yeah. Aspen Opportunity Fund. So this was our diversified real estate fund. So we created this fund beginning of last year, and basically allowing investors that wanted to invest in multiple different projects with kind of a one check and get that diversification with a low minimum, get exposure to different asset classes that we're bullish on. That was kind of the idea behind it. And so we have already made investments in 2 assets in 2 of our retail properties, the Mission Hawk and Lenexa. And so we have 2 other acquisitions teed up and expect that to kind of close out the fund. And so we're going to be kind of doing the final call for capital if anyone wants to invest in the kind of final tranche of this end of this quarter. Both of these
what's the
assets
2 acquisitions?
So
we've got a secret.
Well, we can share a little bit. So we got a really sweet multifamily property that we've actually owned just for a while in Columbia, and it's got low fixed rate debt, and it's got a lot of upside. So we feel there's some great opportunity there, just in a kind of light value add and in a great market with some great fixed debt in place, and can really improve that and take it to the next level. Potential to even build it's about 12 to 18 more units on the property. It's already pre-zoned,
one more building,
ready to go.
Yeah.
So there's a lot of cool things in this project, and we've owned it again for about 2 years. And so we think it's kind of really ready to take it to that next level and have great excitement about that one. And then, which we'll get to in a minute, I don't want to spoil it too much, but we got, another industrial development deal teeing up in Wichita that we're very, very excited about. And the fund is going to be taking a position in that as well. Okay, oil and gas fund updates, and then we're going to shift over to the economic stuff and then Q&A. So,
not going to talk about new opportunities.
Oh yeah, forgot about that. It's in here. The flow is already pre-filled, so we'll get to it. So Riverdance Energy Fund. So this was our oil and gas fund that we did in August of 2022. The idea is to buy existing producing wells and then to do additional drilling to increase overall production and use the kind of cash flow to drive the yields. And ultimately, we're very bullish on long-term prices of energy, and so that's really what got us into this space. We have several funds now. This is our first one. So right now, we're paying investor distributions. Our net yield right now is about 8.3%. So it's definitely lower than we were wanting it to be. Really, the last quarter or two had some severe winter weather here in Kansas, southern Kansas, where these fields are at, impacting production. And we have some higher CapEx costs. We're trying to work through some of these final workovers and other things we're doing. And so that's kind of impacted the cash flow. We've also completed 3 of the 4 wells that we've decided to drill initially. They hit oil, but they didn't really maintain the production levels that we expected. So, those with any kind of drilling, there is risk that you don't hit the big one. But thankfully, we have not hit dry holes on those first 3 wells, and we have additional production. But it's not the kind of big numbers that we were necessarily hoping for. The good thing is expenses have been lower than anticipated, and so that's driven our break-even price of oil lower. And so, oil it's been hovering in the kind of 70s, sometimes get into the 80s. And so, as that goes up, that just is accretive to the bottom line because of our lower overhead of operating costs. So in this scenario, alongside some other ones that are underperforming to a certain degree, we've decided to pause taking any of our fees or carried interest on this project until investors receive their original capital back. And so the idea is just to push 100% of the net cash yield back to investors. And really our goal right now is to optimize the current cash yield. So as we kind of work through some of the CapEx, as we work through some of the production, getting more consistent, higher production, and optimizing the current cash yield to investors. And really over the next several years, if you've followed any of our kind of macro themes on oil, we do remain bullish on energy prices and really think it's a long-term play, which is why when we did this fund, we set it as a 10-year hold, right? We think at some point we think we're going to be right about the oil prices and gas prices. And so we do expect positive outcomes over long term. And so we're doing what we think is right to do to push all those distributions and yields back to investors and to continue to optimize this as best we can to get the yields up. And at a certain point, my gut sense is we've seen a little bit of pullback from capital in the market, which is on the other fund we're actively acquiring assets at really good bases, and so we're excited about that from an acquisition standpoint. Again, there's buyers and there's sellers markets. Right now, it's a buyer's market. When oil prices, go up, which we believe they will over a period of time, and we're hitting some significant shortages, I believe the capital markets will come back roaring.
We'll see buyers start entering the fray. At that point, we would look for an exit.
Yep.
Until then, we'll just take the cash flow.
Take the cash flow. Yep. So to that point, our next energy fund, upstream.
And I want to say, just for the Riverdance investors, I'm one of the largest investors in that fund too. So, it's not what we had hoped, but we do hope for a good exit here.
Yep. So our next energy fund, this one is just off to the races. We really took a lot of things that we learned from our first fund, and as we kind of got into it, realized the real opportunity to scale this and to play this opportunity in oil and gas is to go more institutional grade.
Right.
And so what we did is we found a partner that has a pretty incredible track record in this space, over 40 years experience, really from a geological background and
engineering.
And engineering. And going into institutional grade opportunities. So horizontal drilling, which is
horizontal, rather than drilling a single well like this, there's a lot of risk there. With horizontal, they drill down until they find the layer, then they go sideways. And there's a much lower level of geological risk because the layers are there. So you just spread out. So much less geological risk.
Yeah, and it's a similar strategy where we're going and buying producing wells, and then we're layering in new drilling on top of that. So we like that strategy because you're reducing your risk significantly when you go buy existing production. And so we've already purchased our first two
And
assets.
also the other thing is going with large operators.
Large operators.
So the operators here are all publicly traded companies, very large. I mean, this is their core business, and they're super skilled with some of the best people
very well
on the planet.
capitalized.
High, well, so an institutional grade asset is the way to go here.
Yep. So again, first two assets have been purchased in the fund, totaling $40.5 million. We bought both of those at roughly a 20% present value.
Insane.
So if you,
what does that mean?
You kind of compare
Explain what that
to,
means.
to real estate, that's effectively your cap rate, right? So in real estate, if you get
a cash on cash unlevered return.
Cash 20%. On cash unlevered return. So as
already made our first distribution. That 2 weeks after we closed the deal, distributed a significant chunk of money.
So we're actually a year ahead of our distribution schedule. So because the basis that we're buying these assets at and the cash flow is being generated, we decided to kind of accelerate the distribution schedule. We made our first distribution last quarter, ranging between 15 to 17.7% annualized based on the share classes that you're in. And just found out last week, which is awesome. And we'll be announcing this in the quarterly letter to investors with more detail here shortly. But our third asset has just been identified. Transaction has been negotiated. It's a pretty cool thing because this operator, they need cash to go redeploy into another opportunity, and they need it really quick. And so we said, hey, show us what you got. And we put out an offer, taking a partial interest in, I think it's about 30 different wells working interest, and it's at a 25%
cash on cash
present value.
So incredible returns. Can be super accretive to the fund. So you thought you liked the distributions before. Well, it's going to get even better. So
so we'll continue to monitor those.
And there's no new cap. We're buying that from existing capital. So.
So the fund is closed. We closed. Took the last capital in February, March, and so that will be forward.
And that cash on cash return, by the way, we're anticipating higher returns than that because once there's drilling, now there's not a lot of drilling going on now because of the low energy prices. So our operators are not incentivized to drill, but we anticipate they will. That's on the Oklahoma Strip, using the Oklahoma Strip pricing, which is roughly $70 oil, right? So if oil goes above 70, which
I believe goes down to the 60s over the next couple of years,
it's between $65 and $70 is what the pro forma is built on, and when I say cash on cash returns is built on. So if energy prices are higher, we're going to get better returns than that, and that's exactly what I think is going to happen. So,
right. Yep, absolutely. And it was kind of interesting.
Anybody who's not in oil and gas listening out there, you need to be getting in oil and gas. I'm not saying you put everything in it, but you need to have exposure to oil and gas.
One of the kind of interesting things when we first went in, hey, let's go do the purchase of the assets, producing assets, and then go layer in drilling. Well, what's actually happened is, we've actually thought we would be buying these at closer to a 15% present value because the numbers still work really well at 15%. Right. But the crazy thing is we're buying like this one at 25%. And so you're now eliminating all the geologic risk, all the drilling risk, all the capital call risk of doing the drilling, which, is still worth doing in a lot of scenarios, but we're actually getting way above market returns buying existing production versus,
it just tells you what a buyer's market this is, how hated these assets are. And, last I knew, last time I filled my car, I put gasoline in it, and, fossil fuels are not going away in spite of what we wish, but boy, investors have just shied away from these assets. And, it's politically driven, mistakenly so. And, but this is not going to, this is the time to be backing up the truck and buying as many of these assets as you possibly can, which is what we are doing.
That's what we're doing. And so I'm going to shift to new fund offerings because this is what's coming down the pike. So
this is exciting. What's coming down the pike, Benjamin?
This is fun. So we've really identified kind of three primary verticals that we're really focusing on in 2024 that we think have the best risk-adjusted opportunities for investors and for really capturing opportunity in the market. And so you've probably seen the release of our Aspen Private Credit Fund. And this is something we're super excited about. This is just honestly hit the ground running. And we've already got our first 4 assets locked in. I got a 5th one, term sheet put out today, and they're likely going to very verbally accepted it. So we got a lot of amazing assets in this fund, and it's, from my perspective, one of the best ways to capture, the long-term fundamentals of multifamily are good.
Right.
We're looking from a 3 to 5 year standpoint. We need housing.
There's demand, right?
Demand.
There's a housing shortage.
There's no absolutely about that. But to go in common equity and just to have exposure to cap rate expansion, to have exposure to the other kind of risks involved right now, capital call risk, all these things. The better way to play it is going lower in the capital stack,
private equity,
a more credit focused perspective in it, but we're earning way above market yields because there's this huge gap in the market. So anyway, open-ended fund. We are really excited about it. I have another slide just to share what the structure is on the next slide here. We also alluded to it a minute ago, but Dan, do you want to share just of some of the pipeline we have for industrial? We've been working, or really we, meaning Dan, has been working pretty hard the past year, just building a pretty big pipeline,
deep and
of
sweet
opportunity.
pipeline of industrial coming down the wire.
Yeah, absolutely. Thank you. Yeah, we've got a half a dozen coming down the pike, and some of these are, not just one building, but they're in actual developments where we do up to 1 million or 2 million square feet. Ben alluded to the one that we close on the land in the next 2 weeks, which is on the east side of Wichita, and the way we're looking at these is not just a distribution industrial. We're looking at kind of our thesis on, reshoring manufacturing as well. And so a lot of our projects are around whether a new chip plant is going in, whether a new industrial manufacturing plant is going in. So East Wichita is one that we can talk about. It'll be 1 million square feet in Bel Air, which is close to all the highways, close to all the airports, close to Koch Industries, hopefully close to an expansion of a chip plant. That will be 1 million square feet that we can put up in the next 3 or 4 years.
And we got IRBs on that, so already added a huge amount of value.
Right, fully incentivized and ready to go. Friendly community, they like manufacturing. And then we've got one that's pretty close to being teed up in Oklahoma City, kind of the same type of philosophy there in terms of location and end user, and that one would utilize the rail, which obviously gives you a higher lease rate. And then we've got 3 or 4 others that are in the wings we can't really talk about, but they're in Kansas City, they're in Arizona, we're even chasing some stuff down in Laredo, Texas. So a lot that we can bring online, a lot of capital we can put to work, and so we've got a nice pipeline to build on in the next, we could, 10 to 20 years if we want to stretch it that far.
And to talk for just a second about our why, we're going to tertiary markets, right? The smaller markets, which we like, and we're building while everybody else has their pencils down. So explain why all these things make sense.
Well, it makes sense because we know people are out there in the market looking for buildings. We've run across this in Wichita, is that there's just no inventory. If you go to Kansas City still has room for manufacturing plants. We just like the smaller markets, good locations. Everyone wants to be within, 1 day delivery of everywhere. So people are pulling away from the coast. They're filling in we're filling in, where we can in the smaller markets that have the best location, that are drivable, but also have a very strong manufacturing base. That's kind of what's become our niche in terms of what we're looking to develop.
And talk about the pencils down scenario where there's just not a lot of new construction.
Yeah, there's just not out there. I mean, you've got the large, we've run across this in Oklahoma City where there's a lot of land sitting there, but the large developers have decided to wait for rates to come down to start to build. And in an 18-month lag on building a 250,000 square foot building, we kind of want to be standing there with the only game in town with a finished building over the next 18 to 24 months, right, when everyone else is waiting to,
right,
get their financing and start building and be behind, right, the curve.
Yeah. So over the next 2 years, you're not going to see any supply come out on the market, basically. Yeah, right. And so we'll be the only game in town in these tertiary markets, which are ideal for manufacturing and distribution, right, and in the Midwest, which we love.
Right.
Yeah. And because of the pipeline we built and the key relationships we have, our yield on cost on these assets is really above market. And talking with a lot of different brokers and lenders I've been talking with, and really gives a huge amount of margin. But there's still, like, I was looking at a report from Green Street, which is a huge kind of reporting firm in real estate, and industrial is really by most measures been the least impacted from a valuation standpoint of any real estate asset class. And so it continues to be the darling of the institutional money. They want industrial, they see what's coming, but there's not a lot of transactions happening. There's not a lot of new construction happening. And we feel right now is a really key time to kind of, people are zigging, let's zag with smart projects, with good partners. And, fast forward a little bit of time, we're going to be sitting right.
And again, bringing institutional grade assets to retail investors. So a lot of retail investors are in multifamily, but a lot of them haven't gone into some of these more institutional asset classes, like industrial or like oil and gas. And so we want to bring really best in class institutional grade assets to everyday investors.
Yeah. Yeah, speaking of oil and gas, we got another fund that we're teeing up. We're expecting that to launch sometime this summer. And so really it's going to be
dry out your powder, guys.
Yeah, it's going to be a carbon copy of the last fund, where just continue our acquisition.
As long as the market is in this kind of buyer's mode, we're going to keep building as many funds as we can, buying as many of these assets as we can. And if I'm wrong, we're going to just be happy making, 20, 25, 30% returns. And if I'm right, it's going to be way more than that.
Yeah. So,
and that fund is with the same partner that we have in the other UEF, the other oil and gas fund. So,
Yep. Go back to the private credit fund. I'm not going to spend a lot of time on this because we're a little over time here, but if you have interest in it, we think it's an amazing opportunity to get, current cash yields in preferred positions in commercial real estate, and it has liquidity. So it's got this, really great options for your credit part of your portfolio, where you want to get the yields, where you want to be kind of a lower risk position in investing, and really capture, in my opinion, a great risk adjusted opportunity in the marketplace right now. So we're excited.
Quarterly liquidity. So it's open-ended, which means we think this fund is going to run for 10, 20, 30 years. And you put capital in on any quarter, take money out on any quarter.
So yeah, after 2-year lockup. So not any quarter, but close. So yeah, open-ended fund. Excited about this.
And really, really nice returns.
Yeah. And we're starting out the gate with audited financials and really taking this to an institutional level. We'll likely be working with some larger institutional partners. We already have a lot that have started giving us commitments. And we expect this fund to scale up to a pretty nice size here over the next year or so. Share classes. Okay. Ready to shift a little economic?
All right. Can I get my brain over there or not?
Yeah, let's do it.
Yeah. I just want to talk for a few minutes about some of the things that I'm seeing here coming. And go ahead to the first slide.
There's you.
Yeah, that's me. Okay. Yeah. Go find the slides that I want to talk about. Yeah. So I am increasingly concerned that and if you've been following us for any amount of time, I've been calling for, and we've been calling for, higher inflation, stickier inflation, and higher interest rates. And I've said there's not going to be any rate decreases this year. And by the way, I was saying that a year and a half ago, back when they were saying there's going to be nine decreases in 2024. Now they're down to 2. I don't think we're going to see any. And I've been calling this for a long time, and I'm seeing stickier inflation for 2 reasons. One is energy prices, and 2 is demographics. We're seeing a worker shortage. But the bigger trend here is we're also seeing interest rates continuing to rise, and we've seen this happening. The markets are starting to realize that the rates are going to be higher for longer. And what if everybody I know in the investment space is waiting for rates to normalize?
Right.
What if normal is higher? And the truth is, historically, they are.
Yeah.
And what people may not realize is that short-term rates are set by the Fed, right? By them setting the Fed funds rate. Long-term rates are set at an auction. And so what happens is, the Treasury goes and, they look at the spending that the government's doing, they subtract the taxes, and they borrow the rest, and they make an auction. They basically put together tranches of T-bills, bonds, and notes. and they sell them in the market, and whatever happens, happens. And so if there's a lot more demand for those notes, the bonds go up in value and the interest rates go down. And if there's less the other way around, well, what's happening is we have seen spending go on an absolute rip. And if you've been tracking, I don't know if you've seen, so spending has been on a rip since COVID, and really before, starting with the Obama years. This is the treasury market. This is the quarterly treasury issuances. This is the amount of bonds being sold at auction. And look what's happened since 20, and really even since 15, we're seeing about 3x. And what's happened is spending has gone nuts. And so you've seen there's this idea called modern monetary theory. Okay, MMT is kind of the new economic gospel, especially loved by the more liberal side of the political spectrum. And the idea is that, hey, we can borrow as much money as we want, and it doesn't ever cost anybody anything. And I'm actually a proponent of MMT, but MMT does have limitations. They're right. And what's happening is, because of MMT believing that you can just write trillions of dollars in spending, and we saw it with the COVID crisis, several $1 trillion in stimulus packages, 3, 4, 5 of them. And then the latest one, the Inflation Reduction Act, $1 trillion, and it's pretty much green money spending. It was complete boondoggle, my opinion. And we can't afford any of these things. And the latest one is now forgiving student debt. All these things increases the spending, and we can't continue to afford it. What happens when you increase spending and you're not raising taxes? You borrow. And what's happening is we have seen the last 2 months really weak auctions. So we're seeing auctions, treasury auctions, being very, very weak. The bid to cover ratios are hitting extremes right now. So I wonder.
And weak means less demand.
No buyers.
Yeah.
People don't want it, and that means the rates spike up. And you've seen the 10-year spike up. Are we seeing we're just choking the duck here, and duck's full, doesn't want to eat any more of these things, and we're trying to sell them into the market. At some point, you will see the market barf this stuff out. So go ahead and hit another slide. What is this one? Yeah, the surplus and deficit. This is the deficit spending. This is a kind of the budget. And you can see, you look at the budget. We hit a little surplus there in 2000 with the dot-com era, but you've seen the budget deficits have been insane. And what's happening is the government, Congress, and the president have figured out that let's just run massive deficits. Trillion here, trillion there, forgive this, spend that. And it's fine. And it's great. They're right. It's fine until it isn't. And because we keep having to borrow. And again, I don't think the national debt is a big problem, except that when you go so far that you're affecting the treasury auctions. And I believe we're touching that point, that we're seeing the treasury auctions being too inundated. So the budgets are just nutty here, and our government needs to get reined in and stop spending this stuff. And there's going to be a price to pay, and I believe you're going to pay it at the interest rates. And what that means: higher rates on your credit cards, higher rates for your mortgages, higher rates for all business borrowing. And I'm very concerned that we're going to continue to see rates rise. And I see, and cap rates are related to interest rates, so I can see cap rates possibly rising as well. Go ahead and hit the next slide. The other thing I see about spending is a problem. I actually see spending going to continue even if we don't have some of the stupidity in Congress. And the reason is we have an aging population, which is going to put demands on Social Security and Medicare, and so we're seeing rising interest rates causing more spending on interest. So the spending is going to continue. Next slide. The rise of MMT. So I already talked about this. We've already seen this, this huge spending, and the politicians believe that they can simply spend $1 trillion and it's okay. And it's simply not. It's just not. You can because America is so massive, the economy is so powerful and so strong and so innovative, we can get away with it for a while. and we'll absorb all the stupidity, that's out there. But at some point, it just gets to be too much, and I think we're hitting on the edge of that. Go ahead. Now this, you can't really see it, but if you look at on the upper right, this little curve there, this is the budget for 2023, and this blue outer ring is the mandatory spending. Now, I can't read that, Benny. What is the ring composed of?
Yeah,
there?
Social Security, Medicare, Medicaid, income security programs, and other.
Okay, so that is mandatory spending mandated by law.
3.8 trillion.
So the bulk of the budget spending is mandatory. They can't cut it if they want. And so the next what is the next two? The little inner ring there, the green.
You got non-defense and defense.
So you look at defense as most of it. Well, are we going to pull our ships all back? I mean, this is not the time to be doing that. And then look at what's the inner one.
Interest.
Interest is this one. So that's our budget. There's not a lot of wiggle room. And so I actually see spending increasing, and I don't see a lot of answers here. I think interest rates are going to keep going up. I think I have one more slide. I'm not sure. And yeah, fewer buyers of treasuries. So we're seeing treasuries. So who's going to buy all this debt being issued by our treasury, right? The spending minus taxes equals borrowing. Who's going to buy it? Well, in the past, the biggest buyers has been overseas. What does the chart on the right say?
Balance on current account.
And what's the other one say?
Foreign holding of U.S. debt.
Foreign holdings of U.S. debt. So you can see that dropping. What's happening is as we import stuff, right? We import stuff from China. Well, we pay in dollars to China. So China gets a bunch of dollars. Well, what do they do with those dollars? They recycle them and buy treasuries. But as the imports are dropping, and as we move manufacturing to America, there's less demand for treasuries because of that. And the current account deficit is the same. So we're seeing those numbers dropping there. You can see the current account. And so there's fewer buyers of treasuries. So again, I'm looking at the auctions and saying, I think we're going to see higher rates. I don't like that answer. Right. I'm not excited about that answer, but I just think we're going to see higher rates to come. And I'll say I'm at a consensus. I mean, most economists wouldn't agree with my statements, but I have been right. And for the last several years, and against all the consensus. And I'm not smarter than these guys, that's for darn sure. But I think there's an inherent bias and in human nature of looking at recent things, recency bias, and thinking it's going to continue. Okay, see if I got any other ones, or is that it? Yeah. So I'm agreeing with Jamie Dimon, who says we might see interest rates spike, and it's because of the green economy, the remilitarization, and the restructuring of global trade, creating a problem here in the treasury markets. So
interest rate spike. I mean, that seems very contrary to what everyone's been saying. And like you said, a year ago, people were saying, I think 6 to 9 cuts this year.
Right. That's
slowly, petered off to about 2 right now at the end of the year, but that's looking less likely. Yeah. And now we're saying what actually potential increase, right? That's actually on the table.
That's where we're going. Yeah. I think we're going to see next 5 years, we're going to see rates creeping back higher, and cap rates as well. That's my gut. And so we're building, real estate, but also seeing higher inflation. And so is it, we will see cap rates probably rise for a while, with interest rates, and then we'll see them stabilize, and we'll see inflation continue to take. So short term is like this, inflation continues to go like a banshee, and that's where we make our money.
Yeah, absolutely.
That might be it. See if I got any other ones. I can't remember. Oh, there you go. That's it.
Okay, great.
How was that? Exciting?
That was great.
Yeah,
that was great. No, I mean, not great. I mean, let's be clear.
But it is what it is. But we make money no matter what happens, right? It's not, it's just we change strategies, we shift, and that's we want to be thinking like a hedge fund, And
well, I think it's so important, right? If your thesis is interest will be higher for longer, that's going to change the strategy that you're going to take in to optimize the value of our assets. And so, I think it's prudent, because it's to your point, the recency bias is very strong,
Right.
people, because they got so used to this cheap, easy money, and it
But
made everything.
that hasn't been the norm.
It hasn't been the norm.
It's only since the great financial crisis we've seen the interest rates low like that. Normally, they're not. They're just not that low.
I mean, talk about, you read the book of the history of the interest rates in the world for the past 1,000 years or whatever.
Have a 800-page book on the history of interest rates, through the millennia, and super exciting reading, and I'll give you you want the one sentence summation of this 800-page book. Well, it's 6%. That's historically what rates are, the value of money over time, roughly in the Roman era and whatever.
So it's, the reversion to the mean might actually not be going back down to,
it might be going up
close to zero. It might be higher than that.
But rather than be surprised by this, don't we want to plan it out and make sure we have a plan in place to capture inflation and be able to manage debt loads. And that's the way we're headed.
Yeah.
And by the way, you look at oil and gas, it's unlevered, so.
Yep. A lot less impact to interest rates. Okay, we're going to go to Q&A here for the last 15 minutes. Sam, do you want to take off the slides here and just put us up on the screen, and then scroll up on the comments so I can read those?
Yeah, pull up who is. David had a question beginning about.
He said, appreciate your team. How's your team balancing new funds and opportunities versus maintaining sufficient focus on existing funds, such as the Aspen Income Fund?
I'll jump on that one. The Aspen Income Fund, we love that fund. That's our biggest fund. It's our oldest fund. It's $85 million. We got investor money there. That thing is a little rocket ship. We have an entire team dedicated to that fund. So it is focused on residential. And that's its focus. And honestly, it's not the black sheep by any chance. So, it is. You talk about the differences with the income fund and the private credit fund. So the private credit fund is going to be focused on commercial, and it is focused on commercial, and especially multifamily.
Yeah. The great thing too is, one, there's a lot of overlap potential and cross training that we have internally, right? So a lot of our teams can work in different parts of our business. And a lot of our staff kind of work on multiple verticals, but to the extent that we like the income fund, we do servicing in-house, we do asset management in-house, and so we staff to those functions, and those are dedicated resources to those functions. Whereas our other models, don't require as much depth in the resources or staffing at that level, but we can have a broader perspective and impact on multiple of those.
Great question, David.
Yeah. Jim, do you want to add anything to that? So you pop on there.
Okay, Andy, the commercial bridge loan portion of the multifamily held under the Aspen Income Fund. No. So the income fund holds only residential, and so multifamily, like greater than 5+ units, is considered commercial. And so we're only doing multifamily in the new private credit fund. We do have a couple.
We have a couple.
There are a handful of loans in there that before we started the other. So
yeah. So when Jim was talking about the foreclosures and stuff, he was talking about our note funds where we're doing residential. So it has nothing to do with the commercial, kind of what's happening in the multifamily space.
Yeah, and just to follow that question, Andy wrote, he said, what exposure to the bridge loans where the loan to value exceeds 100% if a syndicate plans to handle potential foreclosure. So in those scenarios, our LTVs are extremely low. I think our average LTV on the commercial ones that we have in that portfolio,
which in the income portfolio,
income fund, are under 50%.
Yeah.
And in the credit fund, it's generally under 75%. And so
I don't think we have anything over 100.
There's
not even one.
Not even close.
Yeah. So great question.
Yeah, great question. But you have a lot of margin, right? Even with values, expansion of cap rates. I mean, that's the whole deal. Is go lower the capital stack, you reduce that risk from potential cap rate increases. So,
Cameron,
excited to participate in more oil and gas funds. Hey, we are too.
I'm getting my checkbook out.
Appreciate the salary distribution on the energy fund. Yes, quarterly distributions moving forward. So that's on a quarterly distribution frequency. And you're asking the minimum annualized return of 15%. So there is no minimum, right? The annualized returns and the distributions are driven by the underlying income being generated from these wells. So we anticipate that the baseline, will be at that 15% level. Based on the assets we have right now, we anticipate that may increase over time. So
the second asset we bought hasn't even, are we taking any income from that yet? I don't think it's even hitting yet.
No,
so it should be
no.
hitting
So
here soon.
Everything's kind of
and then we've got another purchase ready. So it's going to be building.
Yeah. And we still got another 15 to 20 million to go shopping with in that fund, but we have a few kind of acquisitions teed up there. So once it gets fully deployed, right, we're not trying to reserve some cash back to go shopping and for new assets, that we expect those yields to continue to rise.
So, but he's asked, can we say, should he expect 15%, by the end of the year?
Yeah, I think that's right now, as far as everything looks and how the portfolio is performing, we expect to kind of maintain the current distribution yield number. So, yep. So the K1s on the energy fund. So the K1s will likely not be delivered until July or August. And unfortunately, that's just the nature of the energy industry. The reporting is very delayed.
This is the energy industry, Phil. It's pain in the butt. Sorry about that, but the energy industry is very delayed reporting, and we don't have, it's just the way it comes from our servicers.
Yeah.
There's no way to accelerate it.
We don't even get the 1231 reports until April anyway.
So the only thing we could do is have our year end, in Q3 or something, change our year end, and then we could do it, which we might do, because I do hate missing these K1s too. I'm with you. So
yeah, but on that one, we did let people know very early that was, likely going to be delayed, and then we did give potential tax liability to reserve and to make a payment. So obviously, during the weekend, to make that deliver those as quick as we can, but that will kind of be generally the outcome for energy investments. And just as a broad comment, if you are investing in private alternatives, anything that's private, we just generally recommend you extend your tax return,
pretty much.
because the more you invest in these, the higher the chances are that one might be delayed, or in something like this where it's just kind of the expectation you want to do it. So we all delay our tax returns, and it's not a huge deal, but just encourage
it's the way it is.
Yep.
Are you more bullish for the new energy fund 7 versus upstream? Honestly, we're seeing probably the same level of availability of assets and the same level of pricing, which means it's probably going to be just as good.
Yeah. We've not really seen a change in the market at this point, which is why we're trying to buy as much as we can. Because
so at this point, I would see the same level of expected performance. And roughly, when do we expect it to open? Cameron is asking. It would be summer, we're thinking.
Summer, likely late summer. So similar to last year when we launched that in the summer. So once this fund is fully deployed, which we expect that to happen over the next quarter or so, we'll go right back into the market with the new fund and just kind of continue that acquisition pipeline that we've been building.
Todd is asking what bank we use. Yeah, we use Silicon Valley Bank. No, just kidding.
I shouldn't say that. No, we have lots of different banking relationships. So, we're spread across probably 10, 12 different banks across our different assets. So our primary banking relationship, we can talk to you offline, Todd. It's a local credit union here we have a great relationship with, and great platform, great protections for all the borrowers of the bank.
Todd is asking about a bank failure epidemic in the future. Todd, I'm not. I actually am well aware of what happened in 2008. We made a lot of money in the bank failures in 2008 through our distressed debt. If you look at bank health right now, if you look at the distressed banks out there, there's hardly any. There's a couple smaller banks that are exposed to commercial real estate a little bit, and there's a concern, primarily office. It's a very small number. If you actually look at there's a list, the unofficial problem bank list, and you can see there's hardly anybody on there. It's just a very small list. So banks are generally very well capitalized in America right now. We're not at risk. So the housing crisis in 2008 became a banking crisis, and that's when you get systemic problems. Housing crisis don't don't always create a real systemic problem like for the system.
Yep.
But when a banking crisis do, and we're not seeing this becoming a banking crisis yet, so I'm highly confident. You look at the numbers, and you can go look at the aggregate numbers in the banking sector. It's all public information at the FDIC.gov,
Yep.
and you can go see that the banks are actually quite healthy, except for just a teeny tiny number of them, and they're small. They're smaller banks, so
yep.
I'm not concerned at all. All right.
Phil asks, the Upstream Energy Fund co-sponsor has historically averaged 2.5-year hold period. At this point, to anticipate earlier divestment than a 10-year pro forma. So, it's similar to, in any of these assets, there's good times to buy and good times to sell, and those cycles kind of go back and forth, and the time periods between those can be a few years, it can be longer than a few years. And so again, the reason that we created a 10-year hold period for that fund is we want to have the maximum flexibility for maximizing the opportunity in the market, right? If and when the market turns and it's a good time to sell, we'll be selling, right?
But as long as you're making 15% returns, who's in a hurry to sell? It's like,
exactly.
That's just cash.
Yeah. When you're making the kind of level returns you're making, if you're selling, right, it means there's probably not a lot of good acquisitions that you can replace the capital with.
Right.
So it's that dichotomy of what's better is getting all your cash right now or continue to have distribution. So we'll make all those valuations as we go along, and determinations depending on what the market's doing. But right now, when it's a buyer's market, we're focused on buying. At a certain point, that will shift, as it always does, and then we will definitely be evaluating potential sale. So appreciate that question. Great questions, everybody. Francois, love you. Hope you come visit again soon.
Congratulations
Thanks.
to the Aspen team. Come on, and to our Aspen investors. So
absolutely,
who've been with us. We're just so grateful for you all going on this journey with us.
Yeah. Awesome. Well, everyone, thank you so much for joining live. It's I know it's a little bit of a chunk out of your day. I hope that you have a great rest of your day. And if you are in Kansas City, don't forget to stop by in an hour, happy hour at Rye, and would love to see you in person. And then for those that, want to watch this later on, if those that didn't watch and want to watch it recorded, we will put this on our website and send it out here soon to be watched at your convenience. So with that, thanks so much.